Glad to know you stay with us. Nigeria's financial markets are experiencing significant strain as global turmoil from new tariff threats by Donald Trump impacts emerging markets. On Monday morning, local bond and currency markets faced extreme volatility, reflecting widespread declines in global financial markets. Also, Nigeria's net foreign exchange reserves surged to $23.11 billion by the end of 2024, the highest in over 3 years, up sharply from $3.99 billion in 2023, $8.19 billion in 2022, and $14.59 billion in 2021. This, of course, is according to the Central Bank of Nigeria. However, momentum may have slowed in early 2025, with gross reserves falling by $2.57 billion in the first quarter of 2025. The CBN attributed a decline to foreign debt servicing obligations. To help us unpack these headlines, there are about 3 or 4 of them right there. Oladipo Ajayi, the head fixed income and forex ChapelHill Denham, joins me. Thank you so much for joining me today.
Good morning, Perpetua. Thank you very much for having me on this morning.
All right, so let's begin with what's happening this morning. I mean, this was reported that this morning, as of 10 a.m., some amount of money, the CBN had already sold $124 million. And I mean, tell us what exactly is happening.
Well, what is happening currently in Nigerian foreign exchange markets is exactly what is currently happening globally. Post announcements of the tariff increase by the United States of America, we've been seeing a lot of crises in financial markets across the globe. Just this morning, in Japan, there was a circuit breaker in Japan where they had to halt the trading section because of the level of loss that market participants are seen in the market. So this same thing is exactly what's currently happening in our own climate as well. We've seen a situation whereby a lot of foreign investors are currently actually exiting the market. Some of them are actually flying to safety because in a situation of turmoil, the best asset class to actually put your money is dollars. And because dollar is a globally accepted currency, and at the same time, more like the reserve currency. Another investment where you can actually put your money is gold. And that's one of the reasons why you have been seeing a bit of upside movement in the valuation of gold. So currently what the central bank has been doing is that we all know that for a long time the central bank has been saving for a rainy day. So the rainy day has come, so they need to rise up to the occasion. The responsibility of the central bank to ensure stability of exchange rate to ensure stability of the economy, and that's exactly what they are currently doing. There's a lot of panic in the FX market, so the central bank has been in the market. Just last week, Friday, the central bank was in the market actually selling close to $200 million, about $107 million into the market. Same thing this morning. The central bank is already in the market trying to actually meet the demands of either manufacturer that needs to actually buy FX or foreign investor that actually need to lead the market currently.
All right. I'm afraid I will also have to connect with my colleague who is on the field right now, but I'm told we'll have to wait a little bit before we do that. Okay, so looking at what's happening right now, talk to us. Is that helping in any way? Because just on Friday, we knew how much was spent to cushion the impact, and today we've seen another one. And we also hear that, the net foreign reserves has improved. Though the net foreign reserves has improved, we also know that Q1 alone, we have also suffered some form of losses as a result of debt payment. Talk to us about all these.
Well, one thing about reserve is a moving average that is actually shown to the markets. And as at the end last based on what the central bank actually published, net reserve was about over $23 billion, and like you actually mentioned in your intro, that's more like the highest in the last 3 years. Just in 2023, we are just about $4 billion. So it means that the reserve, net reserve, has improved by about $19 billion. So, but what we have seen in that between the month of January and now, the central bank has expended about $2.5 billion, and that is a form of different obligations. We have FX obligation in terms of loan payments, and in terms of servicing a loan, and Nigeria is actually was in market last year to actually issue Eurobond, and that's been more like being the norm in the last 10 Yes, so it simply means that we have to actually service some of these obligations. So in the month of January, we paid about over $500 million and about $280 billion. And in the month of February, to actually meet or service some of these obligations. And aside that, the central bank has been consistently in the market since the beginning of the year. And since, like I mentioned, it is their responsibility. And don't also forget that central bank is more like the highest earner of FX in the market. So they come into the market to actually meet demand in the market when the need arises. And don't also forget, we have seen a situation whereby the central bank also comes to the market to buy. And that's a situation whereby there's a lot of supply in the market, and the central bank now become buyer in such a time like that. And that's exactly what has happened between the month of January till the end of March. And at the same time, we should also understand that there has been a bit of accretion to the reserve as well. So we should not just assume that, oh, it's $2.5 million minus the subtracted from the $23 billion that was the standing value as at the end of December. So currently, I think our reserve will still be around $23 billion because we expect the central bank to have actually enjoyed a bit of accretion from the month of January till today in form of net reserve that could have actually helped to actually pushing the effect of that outflow. And what's currently happened is what is expected. Before now, I think around 2009, 2007, 2009, thereabouts, we tend to see the central bank come to the market on a weekly basis, at least twice in a week, to actually meet FX demand. We've seen the central bank operating in the WEDAS window. We've seen them operating in the outer window. And we are even seeing the central bank actually during the Emefiele period introduce the SMIS window where they actually meet the demand of the market. In that window, banks will submit the demands of their customer, and the central bank will sell to bank who, at the end of the day, will now actually allocate to their clients based on their need. But what the central bank is currently doing is more like is centralizing the window into the FM market, where the central bank expects everyone to go to that market to actually shop for the greenback. And so in such a time like that, it means that when there's depth of liquidity, you expect the central bank to actually come in and actually meet the demand of market participants in such a time like that, and that's exactly what is happening currently in the market. And we feel that the central bank still have the firepower to actually meet the obligation while we are actually expecting the current volatility to actually subside.
All right, just very quickly, I'd like you to comment on this. I mean, I just want to take us back to this, but before then, let's go on a very short commercial break. All right, just to watching Business Edge, and of course, I still have right here with me Oladipo Ajayi. Mr. Ajayi, thank you for staying with me. I'd like us to close on this. While we all agree that, these obligations often lead to a drawdown of reserves, which you also talk about, we always seem to go back, to getting more loans. Even last week, about 2 or 3 loans were announced, whether you want to call them concessional loans, grants, or what have you. How do we get out of this?
Well, I get you, and we can continue to amass FX denominated loans, because some of the impact is the fact that that will continue to put pressure on our reserve, because you need to service some of these obligations, and at maturity you need to actually make good your decision around in terms of actually paying back on those obligations. So I think the government needs to actually look at this thing another way, because currently we have huge FX obligations that are currently sitting on the table in terms of FX loans, both from international financial institutions and from other international agencies, and even from the Eurobond markets. And so I think that time has come for us to actually reduce the rate at which we actually amass FX loan. Because currently, look at what's happening currently in the market now. Oil price is actually dropping. Currently, it's sub 70. And don't forget that we actually benchmark around $70 to the budget. So it simply means that currently we're already operating negative when you compare to where we actually benchmark the price around the budget. And so it simply means that we may not get as much FX as expected. And also forget that we also have issue of this tariff, 14% tariff by United States on Nigeria, and the highest percentage of exports with America is more like petroleum products, and so it simply means that they will actually impact our reserve. And at the end of the day, if we are not very careful, and if this is not well managed, it will further put pressure on Naira. So I think the government, as much as the monetary policy guys are looking at ways to actually salvage the situation, I think that the fiscal policy guys also need to work in line with the monetary policy guys to put a bit of pause in actually amassing FX low, because if that's not done, it will actually put pressure on the reserve, which will in turn actually affect the standard of living of Nigeria.
All right, thank you so much, Mr. Ajayi. There's a lot to talk about, but I guess we'll just we'll end it here. Thank you so much.